Patrick Carmack, what are your thoughts on the meltdown of the financial services sector that we've seen in the past week with the takeover of Fannie and Freddie, the bankruptcy of Lehman Brothers, and the bailout of AIG?
Well, if you look at it historically, it gives you, better perspective, obviously. And, a major economic turmoil, which one can define as, a depression or serious recession, occurs about every 60 years or so, or has occurred in American history. It varies from that a bit, but essentially it's a lifetime. Basically, every lifetime, debt reaches such a high level that people can no longer pay it. And so you have to have some kind of a restructuring that goes on. And that took place, of course, as we all know, in the Great Depression that ended with World War II. And so it's about time for this to happen because we've used every contrivance, every scheme, every artifice that brilliant men can think of to enslave the other people in their society to them in debt. And that's what's happened, and they can no longer pay it. And of course, it hit, and with the subprime mortgages, people just couldn't pay their mortgages. That's usually their largest debt, and so that's where it hit. And we all know, in fact, they did use schemes and devices with the subprimes to fool people to getting a little bit more into debt than they thought they were, but that was enough to push them over the edge. So the whole system's teetering on the brink of collapse. And that's why it's happening now. And it's not unexpected. We have a system. It's called a fractional reserve banking system. That's the cause of it. And essentially it's like a giant spring that, the further out you pull this spring, when you finally let go, it's going to reach a point you can't pull it any further. It doesn't have an infinite distance. And when you let go, the further you've pulled it, the greater the velocity and force of the contraction. And that's what's happening now.
So, in your own words, how does monetary policy play into that? And how does the Monetary Reform Act seek to address that monetary policy?
Well, monetary policy, and fiscal policy, the two main elements that affect our economy, are obviously critically important. The amount of monetary policy essentially refers to the amount of money we have in circulation in our economic system. And obviously, if we have very, very little, that causes economic problems. And if we have too much, it causes economic problems, principally inflation. If there's too little, it's primarily deflation, but basically it freezes up the whole economic system. Ultimately, you'd revert to a barter system or a black market system underneath the surface system. So monetary policy is hugely important. To have it balanced properly is the principal function of the central bank of a nation. And our Fed, that's principally what its job is supposed to be. Now, back in the Great Depression, the Fed, our central bank, is called the Federal Reserve Bank. That's a somewhat misleading name because it's really a central bank. And its branches are also a bit misleading. There's 12 branches because it's really controlled from, by the Board of Governors and the chairman, and they set policy. And so it's really a central bank for this government. That was established in 1913 by the Federal Reserve Act. And the Federal Reserve Act did some good things, but it did two really horrible things. One of those is it gave the power, the way it set up the system, the Federal Reserve creates approximately 10% of our money supply, which it uses various means to get into the economy. The principal means it's used for decades now has been that it purchases treasury bonds on the open market from the holders of those bonds, whether they be individuals, institutions, or foreign nations. When it does so, it creates the money to buy those. So it injects money created out of nothing into the economy. Nothing wrong with that, provided the correct amounts are created. But what the Federal Reserve Act did is then it allows private banks, where that money gets deposited, to lend out 90% of that money. So if we take an example, say $1 billion, then the private bank that gets, let's assume it's deposited in one bank for simplicity here. Let's call it Bank of America. So Bank of America gets $1 billion deposit from the Fed because its clients sold treasury bonds to the Federal Reserve. Bank of America can then loan out $900 million and keep $100 million on reserve. That wouldn't be so bad, but the system allows it to be redeposited, and that's usually what happens. People don't put money under mattresses anymore. They put it back in banks. So let's say they put it all back in the Bank of America for simplicity again. The Bank of America can relend $810 million. They only have to retain $90 million. So they get to loan, it gets redeposited, reloaned, and so on. That process can go on theoretically into roughly 65 times. And what happens is the original billion that the Fed created out of nothing, and which was deposited in Bank of America, gets turned into this, through this reloaning process, into $10 billion. And the Bank of America has created $9 billion and collects interest on it. Now, the Bank of America is a private corporation. The private stockholders benefit from that. That's not typically your average American. That's very wealthy individuals. So it concentrates wealth very rapidly in very few hands in this nation, which is why the middle class is disappearing and a very thin crust at the top of very, very wealthy people benefit from this system, and why they use their wealth to obscure it and to promote politicians who won't touch it.
So can you briefly describe the mechanism of your Monetary Reform Act and how it seeks to address that problem?
Sure. The Monetary Reform Act is simply designed basically to put us in a situation prior to the Federal Reserve Act. And it has really only two steps, so I'll make it real easy on your listeners. And it's not my creation. I wish it were. It's one that we promote. You know, we've refined somewhat and drafted, but it's not. The concepts are not from me. They're from people like Milton Friedman and many monetary reformers prior to him, and we go into that on our website, which is themoneymasters.com. You had mentioned it, and thank you. The two steps are these. Number one, it directs the Treasury Department, not the central bank, the Federal Reserve Bank, but the Treasury Department of the United States to issue United States notes, just like Lincoln did in the Civil War. They were called greenbacks back then. That's where we get that name. Sufficient in quantity to pay off the national debt. Now, the national debt's now approaching $9.7 trillion. And everyone recognizes that, number one, it'd be great to pay off the national debt because right away we wouldn't have to make our interest payments on that debt, which total over $400 billion a year, which is roughly equal to the deficit this year. So it'd wipe out the deficit and balance the budget. We'd also have no debt. But the problem with that, everyone recognizes instantly, it'd be hyperinflationary to introduce all that new money instantly into the economy or even over a period of a year or two. So the second part accomplishes two things. That's why it's two steps, and that is that the law would increase the reserve ratio private banks are required to maintain from 10% to 100%. And this would terminate their ability to create money, and it would simultaneously absorb the funds created to retire the national debt. So with these two relatively simple steps, which Congress has the power to enact right now, it would extinguish the national debt without inflation or deflation in the unjust practice of private banks creating money as loans, which is fractional reserve banking. It would pay out, and it would wipe out the annual interest payment, which would balance the budget. So essentially, and also it would stabilize the economy because it gets rid of this. I use the metaphor of the spring being pulled out and then released. You know, this overexpansion, contracting, boom-bust cycle, which is a precise effect of a fractional reserve banking system. So those two steps are very easy to implement legally. Technically, they're easy, but politically, it would be very difficult to do because you're up against the banks, which control the great majority of the wealth in this country.